Selling options feels like being the casino, but one bad trade can wipe out 6 months of consistent premium collecting. Most new traders view the options market as a binary choice. You either pay a premium to speculate on a big move, or you collect a premium to bet against that move happening. This creates two distinct tribes: the buyers, who are hunting for leverage and explosive gains, and the sellers, who operate like insurance companies, seeking steady, recurring income. But looking at this merely as speculator versus casino is dangerous. The real trade-off involves three mathematical forces: time, volatility, and convexity. Let's start with the seller's greatest edge: time decay, or theta. Every day the market doesn't move, an option loses value. This is the rent the buyer pays the seller for holding the position. This makes selling options feel incredibly safe initially. You can be wrong about the direction, but if enough time passes, you can still profit. This is why sellers often boast high win rates. However, buyers possess the advantage of convexity. When a buyer is right, their profits accelerate. A 5% move in the stock might yield a 100% return in the option due to gamma. This leads us to the win rate illusion. Sellers often win 80% or 90% of the time. Buyers might only win 30% of the time. But win rate is meaningless without considering the payoff ratio. A seller is often risking $500 to make $50. One max loss wipes out 10 winning trades. This is the classic eating like a bird, pooping like an elephant risk profile. Conversely, the buyer has a defined risk. You can never lose more than the premium paid. If you buy a call for $200, that is your maximum liability, no matter if the stock goes to zero. This defined risk creates a safety net for buyers, while sellers face tail risk. In a market crash or a short squeeze, an undefined risk selling strategy can lead to catastrophic losses beyond your account size. So how do you choose? The primary filter should always be implied volatility, IV. IV tells us if the options are expensive or cheap relative to historical norms. When IV is high, premiums are inflated. This is the best time to be a seller. You are collecting more premium for the same risk, effectively widening your break-even points. When IV is low, premiums are cheap. This is the time to be a buyer. You pay less for the leverage, and if volatility expands, you profit from both the move and the increase in vega. Another critical factor is your market outlook. If you expect a massive, fast move, buying captures that convexity. Selling in front of a massive move limits your upside and exposes you to gamma risk. If you expect the market to grind sideways or move slowly, buying options is a losing game. Theta will eat your premium faster than the stock price can move to offset it. Successful traders rarely stick to just one side. They operate dynamically. They sell premium when fear is high, and they buy premium when complacency sets in. Let's look at the risk-adjusted return. Selling strategies like the wheel or iron condors offer smoother equity curves but sharp drawdowns. Buying strategies have jagged curves with occasional home runs. To manage the seller's risk, always define your exit. Use credit spreads instead of naked selling to cap your max loss. This turns an undefined risk into a defined one. To manage the buyer's risk, avoid holding until expiration. The majority of theta decay happens in the final 21 days. Buyers should look to exit moves quickly rather than holding to zero. Ultimately, the choice comes down to your personality. Do you prefer a high win rate with the constant threat of a rare disaster? Or do you prefer losing often to catch the occasional windfall? Remember, the market pays you for taking risks that others don't want. Sellers get paid for taking on fear. Buyers pay to alleviate that fear or chase greed. Here is the final decision matrix to help you choose the right side of the trade based on the current market environment. Respect leverage, manage risk, and trade smart.